I now hand the conference over to Hemant Bakru, Head Investor Relations, Jubilant Ingrevia Limited. Thank you, and over to you, sir.
Thank you. Good evening, everyone. Thank you for being with us on our Q4FY21 earnings conference call. Please note, effective 1st February 2021, the life science ingredients business of Jubilant Life Sciences Limited demerged into Jubilant Ingrevia Limited. I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in our press release as well as earnings release. On the call today, we have Mr. Shyam Bhartia, Chairman, Mr. Hari Bhartia, Co-Chairman, Mr. Rajesh Srivastava, CEO and Managing Director, Mr. Prakash Bisht, CFO of Jubilant Ingrevia, and Mr. Arvind Chokani, Group CFO. I now invite Mr. Shyam Bhartia to share his comments. Over to you, sir.
I would request Mr. Shyam Bhartia to please unmute yourself from your mobile phone.
Sorry. Thank you, Hemant. Good evening, everyone. I hope you all are in good health and keeping safe. We are glad to announce that we performed well during FY21. Despite COVID-19 related challenges, we reported significant growth in our revenues, EBITDA and PAT in FY21. All our sites remained operational throughout the pandemic, and initiatives were taken to mitigate COVID-19 impact. Supplies of raw material, availability of logistics were ensured for uninterrupted servicing of our customers, and strict COVID protocols were followed at all our sites and offices for safety of our employees. We also take this opportunity to thank all our employees who have worked tirelessly across all our plants and offices to ensure continuity in company's operations while continuing to serve our global customers. Demand scenario in all our business segments continue to be strong. As communicated to you earlier during our last communication, all growth plans are going on track, and our FY22 capex investment is estimated to be in the range of rupees 300 to 350 crores. The team is continuing to work towards meeting the plans. I am happy to inform you that during the last year, the company reduced net debt by rupees 594 crores. The company continues to focus on debt reduction over the coming year. We would like to inform you that the board of directors of the company at its meeting held today has recommended a dividend of 35% for the year ended March 31st, 2021. With this, I would now hand over to Rajesh to discuss about the business in detail.
Thank you, Mr. Bhartia. A very good evening to all of you. At the outset, I hope you all and your loved ones are safe and healthy. I would like to welcome you all for joining this very first quarterly investor call of Jubilant Ingrevia Limited. It gives me immense pleasure to report a stellar performance of Jubilant Ingrevia for the Q4 as well as FY21 in all the parameters. Revenue during the quarter was 1,078 crore, which is growth of 31% year on year, driven by 17% growth in specialty chemicals, 22% in nutrition and health solutions, and 46% growth in life science chemical business segment. EBITDA during the quarter was rupees 203 crore, which is up 101% year on year, led by significant growth in life science chemical business and also in specialty chemicals as well as nutrition and health solution business. Now let me take you through the updates on all our three business segments. Specialty chemicals. During the quarter, our specialty chemicals business has seen strong demand across all our products due to better demand from pharma as well as agrochemical industry segment. Business continued to see higher demand, resulting into revenue growth of 17% and EBITDA by 9% during the quarter on year-on-year basis. Business has delivered strong performance during FY21 with revenue growth of 2% and EBITDA growth of 13%, along with improved EBITDA margin of 23.9%, which is 243 basis points higher than FY20. Input prices as well as logistic costs during the quarter have gone up sharply, which was successfully passed on by price increase of our finished products. Withdrawal of MEIS benefits on exports sale by the government have impacted our EBITDA as well as margin during the quarter. Due to paraquat ban in Brazil and Thailand, pyridine prices were lower, however have stabilized during the end of the quarter. On the other side, since pyridine and beta is produced as co-products, due to paraquat ban, as expected, we saw reduction in pyridine beta production globally and hence tightening of beta availability in marketplace. This has resulted into improvement in beta picoline prices. During FY21, specialty chemical business has commercialized 6 new products and have more than 30 new products in pipeline, which are to be launched in next 2 to 3 years. Demand of our specialty chemical segment continues to be stable. Our first phase of diketene project is on track, and we expect to start our commercial production from this plant sometime during Q3 FY22. Our CDMO business is getting better traction in demand of existing as well as new products. Business is working to maximize capacity utilization through debottlenecking. Nutrition and health solution business. During the quarter, as the market started opening up in different parts of the world, especially in Europe and USA, business has seen strong demand across all parts of the world. Due to strong demand, the business has recorded revenue growth of 22% and EBITDA by 9% during the quarter year-on-year basis. About 80% of revenue of nutrition and health solution business is from exports, and withdrawal of MEIS benefits on exports by the government has impacted our EBITDA margin during the quarter. The business has delivered a strong performance during FY21 with revenue growth of 17.3% and EBITDA growth of 37%, along with improved EBITDA margin of 20.7%, which is 300 basis points higher than that of FY20. Pandemic created some supply chain challenges in terms of less availability of containers and ships, which has led to increase in global ocean freight costs for Europe and North America. However, due to strong relationship with shipping companies and container suppliers, the business was successful in placing the products to our global customers on time in full. Though the demand in animal nutrition segment was subdued due to pandemic, specifically in poultry segment, the business has successfully achieved higher volumes of choline chloride and our specialty premixes. Demand of nutrition and health segments continue to be stable. Raw material and logistic costs continue to be higher, and business is trying to pass on this through price increase of finished products. Life science chemical business. We saw very strong performance in life science chemical business segment with 13% growth on revenue and 138% growth on EBITDA, along with margins of 13.6% in FY21. Business has seen a strong demand of acetic anhydride in almost all the segments. In pharmaceutical, we can see surge in demand of paracetamol due to ongoing pandemic, resulting into a higher demand of acetic anhydride. Due to higher demand of product, the capacity utilization of all our 5 plants and specifically acetic anhydride in 3 locations for Gajraula, Mira and Bharuch have gone up. Our new capacity at Bharuch, which got commissioned in FY20, has come very handy in serving this increased demand. Though this business has faced significant input cost increase due to much higher price of acetic acid, utility costs and logistic costs, it was successfully passed on completely. Business has achieved a significant improvement in process efficiencies, thereby reducing consumption norms of raw material and utility, along with some capacity debottlenecking through Lean Six Sigma. This has led to variable cost reduction and improvement in EBITDA as well as margin. During the quarter, global production of acetic anhydride has been impacted due to the pandemic and other reasons. While the company was able to offer higher volume to the market, which has created a favorable market condition of acetic anhydride, leading to higher price realization and improvement in EBITDA and margin. Demand of ethyl acetate was also strong, specifically due to higher consumption of inks and adhesives used to manufacture packing materials, which is in high demand due to increase in online purchases during pandemic. Higher input prices have impacted working capital of small-scale producers of ethyl acetate, which has resulted into creating a favorable market condition for us, leading to higher price realization and improvement in EBITDA and margin. Business has demonstrated higher level of agility and resilience in servicing all our loyal customers globally, on time in full, using its strong distribution channels, differentiated supply chain during this unprecedented time of pandemic. During the quarter, sales of newly launched product propionic anhydride has been impacted due to pandemic, and we would see better traction in the coming quarters. In our life science chemical business, acetic anhydride market situation continues to be favorable on account of higher demand and lower availability due to restricted production output in certain parts of the world. With this, I now hand over this to Prakash to discuss the financials.
Thank you, Rajesh. A very good evening, and I thank everyone for taking out time and joining us on our first ever quarterly earnings conference of Jubilant Ingrevia. I hope you are all in good health and keeping safe. I would like to start with explaining the basis of preparation of performance numbers for Q4 and FY21 on continuing basis. During the quarter and for the year ended March 21, consolidated financial results of the company comprises results only for 2 months of operation, that is February and March, after the demerger became effective. However, to provide the comprehensive picture of operation of the company on continuing basis, we have presented the results for Q4 FY21 and FY21 in the investor deck and also on this call by combining the relevant portion of the LSI segment results from the published results of Jubilant Pharmova Limited and published results of Jubilant Ingrevia in the following manner. The results for 10 months of operation, that is from 1st April 2020 to 31st March 2021, and previous year numbers have been taken from the reported discontinued operation of LSI segment in the Jubilant Pharmova results. The same information is also disclosed in note 10 of our consolidated and standalone results. The results for 2 months from 1st February and to 31st March has been taken from the audited results of the company. Revenue from operations during the quarter was 1,078 crores as compared to 823 crores in Q4 last year. Reported EBITDA during the quarter was at 203 crores as compared with 101 crores in Q4 FY20, with margins standing strong and 18.8% versus 12.3% in Q4 FY20. Revenue from operations during full year FY21 was at 3,491 crores as compared with 3,179 crores last year. EBITDA during full year FY21 was at 627 crores as compared with 409 crores in FY20, with a margin of 17.9% versus 12.9% in FY20. Depreciation and amortization expenses during the quarter was at 32 crores versus 31 crores in Q4 FY20. Finance cost during the quarter was significantly lower at 12 crores versus 24 crores in FY20, a reduction of 51% year on year. Reported PAT during the quarter was at 95 crores after reduction of exceptional item of 13 crores as against rupees 48 crores in Q4 FY 20. And PAT for full FY21 was 360 crores against 220 crores in FY20. The company witnessed significant deleveraging in FY21, whereby its gross debt reduced by 747 crores in FY21 and the net debt reduced by 594 crores. The net debt stood at 431 crores as of 31st March 21. Net debt to EBITDA now stands at 0.7 times. We generated healthy operating cash flows before CapEx and interest payments during the year. Capital expenditure during the year was 122 crores. With this, I would like to conclude our opening remarks. We will now be happy to address any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, you may press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Veera from Abacus Asset Manager. Please go ahead.
Hi, sir. Congratulations for good set of numbers. So just want to understand in terms of the subsidiary that we have incorporated, what is the rationale there, and are we going to incorporate the whole specialty segment within the LSI into the subsidiary?
Rahul, in our investor call in March, we have informed that we are trying to get into agro-active business. And at Bharuch, we had an opportunity to open this new company to start agro-active business. So that's why we have incorporated it. So we have already intimated that this business we will be planning capex investment this year, and the business will be ready after 12 to 18 months. So that is what this subsidiary will do, and nothing else. So all other business remains as it is.
Okay. Sir, and the capex that we have mentioned for 300 to 350 crores, by when it is expected to come online?
So these capexes are for this current year. So this is the capex outflow for the current year, and there are various projects which are part of this capex investment.
Oh yeah. So but when it will start generating revenue, sir?
So any capex which you take, it takes at least 12 to 16 months. So I'd say some capexes will start generating revenue at later part of this year, and most of which will come into the next year.
Sure. Fair answer. Thank you so much.
Thank you. The next question is from the line of Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Good afternoon. Congrats for a good result. The question is, how much deferred tax asset you have in the balance sheet?
Prakash?
Yeah. So, sir, we have a MAT credit of 160 crores.
So you will be continuing on this 33% rate of tax for a piece of time?
Yes, sir. At least for the next 2 years, we'll continue to have this old tax regime till the time we utilize our MAT tax credit. So during this period, our PMS charge will be in the range of 30%, but the cash tax will be only 17.5%.
And what is your net debt as on 31st March?
431 crores.
So you hope to substantially reduce it this year?
So this year we have a good cash flow, but we also have a capex lined up for about 300 to 350 crores. After adjusting the capex, at least we don't hope to increase that.
And what is the areas in which you are making this expansion? Hello?
Sorry, I could not hear you.
In which areas are you incurring this capex?
So, sir, we have
informed this in the March. Mainly, we are investing in specialty chemical business, which is diketene, agroactive, and CDMO business. We are also investing in one of additional anhydride plants, which we had informed in March, and some investment in our nutraceutical business. So these are the key investment plans which we had indicated in the March, and that is what we are going to follow.
And all our plants are working at full capacity, or there is scope to further increase production from the existing capacity?
Our plants currently are working in the range of 85 to 90% capacity utilization, but we continue to do the debottlenecking and minor extension of existing plants based on the demand. So that goes on parallelly to this new investment. So, and with that only we keep taking the increased demand scenario of various products. So that continues.
And you have now incorporated one subsidiary, no? So what is that subsidiary going to do?
So I just replied prior to your question that this subsidiary is incorporated to do the business of agroactives. As I mentioned, one of our investment plan is to enter into agroactive because we are producing already a lot of specialty value-added intermediates for agrochemical companies. Now there is a good traction for agroactive business. So we are going to launch agroactive business through this subsidiary. So we are going to invest in a plant, which will be a multi-purpose plant where we produce agroactive, and also we will do some agroactive CDMO business.
But why are you making a separate subsidiary for that?
Because the tax advantage, because you get a lower tax because of the new company benefit.
Fair enough. And what is the investment envisaged in the subsidiary?
So in let's say 2 to 3 years horizon, this should be about 200 crore, 150 to 200 crore investment.
And where are you putting up the plant?
In Bharuch, in our special economy zone.
Okay, so thank you.
Thank you.
Thank you. The next question is from the line of Vineet Gala from Monarch Network. Please go ahead.
Hi, thanks for the opportunity. At the outset, congratulations on an excellent set of numbers. Sir, can you please articulate on the pricing scenario in acetyls? How long can the current pricing last, and what percentage of our acetyl business do we deal with our clients on a long-term basis?
So, as I explained in the speech, that the demand of acetic anhydride is continuing to be good today. So we don't see any erosion in prices. At the same time, input prices are also very volatile. So I hope that the current scenario of pricing and also the demand continues for some time, definitely.
Okay. Fair enough, sir. So also, like what you mentioned is that we'll start servicing the diketene clients, I think Q3 FY22 onwards. So, sir, where is this plant? From what plant are we servicing from?
So we have made an investment in the FY21. We have committed investment which will come in production by FY22 Q3, and this is where we will produce the diketene derivatives.
At Gajraula.
At Gajraula, yes.
Gajraula. Okay, sir. So also, sir, this is over and above the capex that we've already done for diketene-based products is over and above incremental capex that we have mentioned in our March presentation?
No, this is the same capex. The second phase will come after that.
Okay. So, and what would be the peak sales in diketene that we can do, and also if you can articulate a bit on the opportunity and pricing in the segment, because of our entry and this is already well contested as a segment, at least the domestic part of it. So can you please elaborate more on that?
Yeah, so I think I have clarified this in our last call also, that when we are looking at diketene derivatives, India is one of the markets, but we are also looking at diketene derivatives for global market. So of course, India demand is growing. We will try to cater that, as well as our value-added derivatives of diketene will be focused for the customer's requirement outside India as well.
Okay. So, but like in domestic market, are we anticipating any kind of pricing pressure because of the incumbent?
No, there are more imports than our production likely to be. The imports are higher than our production is what is likely to be.
Okay. So what we are expecting is
imports rather than from local companies.
Yeah. Okay. So my last question is on this pyridine. So given that ADD was removed by the Chinese, ADD was removed by China. So I mean, what is the outlook on both EBITDA margins and growth front? Because some of the smaller players are reporting, say, very good EBITDA margins.
You are talking about pyridine or specialty chemical as such?
Pyridine, specifically pyridine.
So pyridine, beta together. I mean, as I explained in the speech, that pyridine prices have been under pressure, but now pyridine prices are stabilizing. We have seen in last couple of quarters the prices are getting better, and along with pyridine, beta prices are also getting better. So that's what you are saying is right. The overall situation of profitability in pyridine beta is better.
Okay, sir. So I'll come back to it. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Thanks for the opportunity and congrats on the set of numbers. So the first question is the current expansion that we are doing. How much time we will be able to utilize the incremental capacity optimally? So in this year, you have already mentioned that we'll be doing close to about 300 to 350 crores of capex. So for how many years this particular capex will be utilized from a plant capacity perspective? Thank you.
So usually whenever we make any investment in capex, mostly it is for the increased demand. So within, let's say, 12 months period or 15 months period, we try to see the utilization of 60-70% of our capacity. So I would say in 2 years' time, probably most of the cases, in some cases it is early, in some cases it will be more, but on an average, 1.5 to 2 years the capacities are utilized.
Sure, understood. So the second question is in terms of individual segment margins. So we have seen that last year there been increase in input costs as well as the product prices. So on a sustainable basis, what would be the individual segment margins that we are looking at? Thank you.
So it is very difficult to give you specific comments on individual segment-wise margin going forward, because as you know that the input prices are really fluctuating very, very high. So what we can only say is that we are trying to see how good we can pass on those input price increase so that we can maintain margin. But very difficult to say how we can increase or what we'll be maintaining in future.
Yeah, thanks. Sir, just a concurrent question to that. How much time lag does it take to increase our product prices based on the input price increase normally?
Yeah, so depends on product to product. In some products where we don't have longer time orders, the pass on can happen fast. Some products we have quarterly orders, the pass on can happen a little bit later. But depends on product to product. But we try to pass on as soon as possible. Immediately we take the decision. As soon as the price increases, we try to convince the customer and try to pass it.
Thank you so much and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Dushyant Mishra from Sage One Investment Managers. Please go ahead.
Hi, good evening. I just had a question that the previous participant just touched upon. You said that the capex is due to increased demand. Should we assume that clients have already approached you about utilizing your Daiichi outputs, or are we going to be doing a lot of business development on that front before we can start to see revenues?
Yeah, so some of the clients have reached to us for the requirements, and in some of the cases we have developed the value-added products, and therefore the customers is very keen to look at us supplying those value-added products.
Understood. Okay, and the second question is, So on an incremental basis, once all of this CapEx is done, at the end of the 3-year cycle, what kind of captive consumption can we assume? Currently, we're utilizing 25% of our life sciences for specialty chemicals, and then 45% of premium picoline for nutrition. How will this change going forward?
You are specifically talking about the existing products. There will not be much change.
No, after this CapEx is done.
After this, it is very difficult to quantify right now, but our endeavor is always to keep adding value to our existing products. But at the same time, if there is a requirement of existing products, we don't say no to customers. So both we will parallelly work, and we'll see how it turns out.
Understood. And just one quick question: has there been more traction on the CDMO front? Have you been able to see any more inquiries or customers coming us that way?
Yes, there has been better traction in CDMO side, which I have mentioned in the speech also, both in pharmaceutical as well as in agrochemical segment.
Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Ritvik from One Up Financial Consultants. Please go ahead.
Hi, thanks for the opportunity. Just one question. So in the March analyst meet, you had mentioned that we're looking to do a capex of 900 to 1,000 crores over FY22 to 24. So are we on track for that? And also with the increase in demand, do we look at higher capex going forward?
I think Chairman has already mentioned in his speech that all our growth plans are on track. So whatever we have talked in March, we are following very, very, very focused way. And so far we can say we are on track. And I hope we will be in a position to take it through the way we have planned.
Okay. That's it from my side. All the best and thank you.
Thank you.
Thank you. The next question is from the line of Neha Agarwal from Stage One Investment Managers. Please go ahead.
Yeah, thank you for taking my question. So, just want to touch upon a few points. One is for diketene. While you did mention that there is some demand from the existing customers, at a broader level, is it going to be the existing client base that we'll be leveraging on, or will we getting into newer markets or going for new client acquisition there?
I think I've already mentioned it, that we are looking at as a global as a market. So if there are existing clients who needs our product, we will be definitely very happy to supply them, as well as we are looking at customer outside, as well as we are looking at value-added products from diketene. So all the three areas we are working. We will see how the scenario turns out, and we will take the direction accordingly.
So are the sales more institutional there, or is it that typically happens through, say, a lot of distributor channels?
No, we mostly work with direct customers.
Understood. Also, just one question on the life science part. The margin expansion has been quite significant. Could you give a split between, say, the price growth part versus the volume growth part? I just want to understand how sustainable are these.
So in Q4 as well as in FY21, we have grown both in volume as well as in price. So the result which you see is because of both. As I already said, that our new capacity which we added in FY20 has also come very handy to service the increased demand. So that volume also has grown as well as the price has been favorable. So the result you see is result of both.
So if I say could be blended numbers for entire year FY21 from the performer, can we expect similar margins to be maintained going forward? While you did mention about passing on the prices and maintaining margins.
Yeah, so it's very difficult to comment on quarter margin or EBITDA. But definitely we can say one thing, that our overall FY22 performance should be better, both in revenue as well as in EBITDA, better than the FY21. That much we can definitely say, but what happens quarter on quarter, very, very difficult to comment on.
Sure, that's it from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Ashish Thakkar from Motilal Oswal Asset Management. Please go ahead.
Yeah, thanks for the opportunity. So, could you also comment on the ethanol vending program, which is extended by the government of India, and how do we see this benefiting to us?
So, as you know that we have the capacity of ethanol to produce some capacity which we are reaching to EDP as well as to our other customers. We have not taken up any capacity extension there. So I don't see that there will be any increased supplies of EDP volumes, what has been announced from our capacity right now. So we will be serving whatever we have customer and whatever volume we are currently servicing.
Okay. Yeah, fair enough. So my next question is on this dieting chemistry, wherein Lakshmi Organics has a commendable market share in India. So as you said, there is a lot of import substitution to be played out. But on the international side of this business, would you be catering more to the CDMO side of the business, or you feel it would be a normal B2B arrangements?
So both. I mean, there will be CDMO opportunity on agrochemical side as well as pharma side, but also we have great opportunity on a lot of value-added products. So that is what we are targeting also, beyond the existing domestic market.
Okay. So, and given that there is some kind of a technology barrier to this part of the chemistry, how do you see the competition shaping up? Because if the space grows more profitable, then obviously it's bound to attract more competition. But how do you read the market then?
So as we have mentioned this point that this chemistry is not easy. It's not easy to really any competitors to get in. There is a lot of barriers to this technology. And we, being the largest producer of this technology, that is ketene technology, I think for us it will be easier to multiply in terms of capacity, and that's why we have a plan for phase 2 as well. And having said so, we can't rule out any competition, but it's not easy in this kind of technology to get in so soon.
Okay, fair enough.
Because we are developing this technology in-house. So the value-added product we are developing in-house, the ketene we are operating for many, many years. So we have very high expertise in this area.
Okay. So it's a very broad chemistry in the sense that there are so many products you can manufacture using this chemistry. So what is the kind of a product bouquet that you are planning to start with?
So there is a broad chemistry, but you know that there are the basic building blocks are hardly 6 or 8, and then there are at least dozen of high volume, high value intermediates. Of course, I can't speak specifics. So those are the products we are already developing, which are required for pharmaceutical as well as agrochemical, and that's our long-term plan.
Okay, this is very helpful. Just one last question from my side on vitamin B3. So primarily, which are our target markets, like domestic, or sizable portion also comes from the international market?
In vitamin B3, I think you missed my point in speech. We have almost 95% of vitamin B3 is export. Our domestic supplies of vitamin B3 is hardly 5%, very small value. Mostly export, all across the world.
Okay. And are there any capacity expansions, particularly in this vitamin B3 category?
Yeah, we continue to do that because vitamin B3 we have grown from very low level to this high level. We have already done debottlenecking last year, and we plan to do it maybe after 1 year more. So as the demand is growing, as we are entering into value-added segments like food and cosmetics and pharma also now we are planning, I think we have to keep adding capacity, which we continue to do that. I have mentioned that already.
Okay. Yeah. Thanks. This is very helpful and all the best.
Thank you.
Thank you. The next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Hi, good evening, and thank you for the opportunity, sir. Sir, in a recently published RHP, there was this mention that our top 5 products contribute 70% of sales and maybe top 10 does 80. So if you can just would like your comment on the product concentration that we have.
So our top 10 products contributes to, I think, 65-70% of our revenue.
Yes.
That's the way it is.
Going forward, it will be as concentrated as this. I mean, do you see any risk to this part, or are we working on diversifying our shares from different products, or how do we look at this number?
So, if you see specialty chemical business, this is not a very high value product base, but they are high contributing products. So you will find the specialty product with a sales value of, let's say, 10 or 15 crore. But we definitely have those technologies, the strength to have those products. So we are not hesitant to bring a new product which has a size, with good size revenue, and it fits into our technology base and existing facility. We would like to take those products. But there are plans to bring products like diketene derivative, etc., which are large value, and agroactives, which are large value for future. So those are we are having mix of that, large value growth products as well as small revenue generating products with higher margin from the same base technology. So both are mixed, which we are targeting for future.
Fair enough, sir. And if we look at a gross margin on an annual basis, it's almost same as last year. So a large part of our operating margin improvement has come via maybe leverage or lower costs. So how much of this is sustainable? I mean, is a large part where we were able to cut costs due to COVID and some of it will come back?
No, I think our margins, which have improved in some segment of business, which has come from better volume as well as better price.
Okay, fair enough. So operating leverage largely.
Yeah.
Fair enough. And so last question, this exceptional expense of 13 crores, if you can just highlight the thing.
Can you?
Yeah. So this is towards certain old unusable assets which we have discarded during the year. So this is towards that. It's more exceptional than routine.
Oh, okay. So you said write-off of some older assets?
Yeah.
Okay, fair enough. Sure. So thank you and congratulations on good performance. All the best.
Thank you.
Thank you. The next question is from the line of Rushabh Sherdalal from Praveen Ratilal Share and Stock Brokers Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations. Just had 2 questions, both on the diketene front only. So, the present revenue of FY21, as I see it, is some 3,500 crores. So just wanted to understand what percentage of revenue do we derive from ketene, diketene and the diketene derivatives?
It's very difficult to give that specific number as of today.
But any approximate ballpark number, that number of revenue and margin?
As we said, we will be bringing the product in Q4, so I'm sure it is not going to be significant. So again, it's very difficult to give that specific number.
Okay. And the second question is pertaining to the capex of rupees 900 crores that you have planned for diketene over the coming 3 years. So what percentage of this capex do you anticipate it is going to be funded through internal accruals, and what percentage through borrowings?
Sorry, I think you have misunderstood that we are planning 900 crore for diketene. Is that what you are saying? No.
No, I mean, for this I am talking about the entire capex.
Entire capex, okay.
Yeah.
So I thought you were saying only diketene.
No, I just misspelled it.
Yeah. Okay. So 900 crore entire capex, as we mentioned earlier also, that most of it will be from internal accrual because we have a good cash situation going forward.
Okay, so by most of it, can I assume that almost 60-65% will be from internal accruals only?
It's very difficult to put a number around it, but because this entire amount is not coming in 1 year, So we have said 900 for 3 years. As you would also notice that for next year, we have said in the range of 300 to 350 crores. If you look at our operating cash, you would realize that we are generating sufficient cash. So it appears that we will be able to meet it from internal accruals. But as the years go by, that we will know exact situation.
Okay. Fair enough. Thanks a lot, and congratulations once again. Thank you.
Thank you.
Thank you. The next question is from the line of Swarnabh Mukherjee from Edelweiss. Please go ahead.
Hi, sir. Thank you for the opportunity and congrats on a good set of numbers. My first question is on your nutrition and health solutions business. So wanted to have at least a qualitative view from you on how the margin, the profitability has been in this business given the current scenario and the sustainability of the same going forward.
So nutrition segment business, our products demand is stable. However, as I mentioned, that input prices are changing very drastically. You can see every 10 days, 15 days price change are happening. And as I explained in the earlier questions, that our endeavor is to pass on the price as much as possible. So it's difficult to say what margins we will continue to maintain quarter on quarter, but we try to meet up the demand and we try to pass on the input price increase. So we see that demand is going to be stable or good, and that we try to service the whole demand.
Sure, sir. So, sir, if I rephrase the question in a slightly different manner, wanted to understand from you, given your historical experience in this vitamin B3, B4 segment, where has the profitability been in the last, say, 1 year in FY21 vis-a-vis your history? Is it on a higher side or is it at an average or lower than the earlier years?
I think last FY21 has been good. I would not say lower or better, but it has been good. We still expect the better pricing in future, as we mentioned earlier also, because of the raw material availability of beta-glucan.
Okay. Is there a possibility of also better profitability coming from value-added grades that you had mentioned, like on the human health side?
Yes, you are right. That those segments give us better pricing, and that is the reason we want to also have good product mix of those grades. But at the same time, that volumes of those grades are limited. So the feed is a major volume, but food, cosmetics, pharma, they are also growing. So we want to take the major share there, and we are working for that. Those segments gives better margins and prices. You are right.
Okay, sir. So can you throw some light on how the approval cycles are on these segments, say pharma or cosmetics similar side from your customers?
So in cosmetics and food, we are already there in the market. We are supplying to many customers. We are approved with several customers. What we are trying to do is enhance our market share. In terms of pharmaceutical segment, we are working to make our plant FDA auditable, US FDA auditable. And yes, there is a approval process of almost, I think, 12 to 16 months. But that's what is the timeline, but we are working on that. Once we are ready, we will offer the products to the customers maybe in next 1.5 years time.
Okay, sir. Any color you can give on, over the next 3-4 years, any proportion in the overall the nutrition health solutions segment that you have in mind, which is that will contribute the pharma, food, the higher margin products?
So we are actually targeting all the segments. By targeting food, pharma, and cosmetics, it does not mean we are not targeting animal feed also. So as I mentioned, we are increasing our capacity because being market leaders, we have to continue servicing all our customers. So you will not see the significant percentage change because our overall volumes are good. But yes, these segments, our our market share we are targeting to be improving going forward.
Thank you. I would request Mr. Mukherjee to rejoin the queue. The next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead.
Yeah, thanks for taking my question. So one clarity, in your presentation you have mentioned that life science chemical business on year-on-year basis price has been stable, yet we have margin has doubled. So is it because we have increased the price of end product despite that raw material prices has been stable?
Yeah, wherever there is an opportunity of market condition, we try to take price increase, which has happened in the past. So you are right.
Okay. Or apart from this, do we have other products also in this segment where we have seen significant increase in prices?
So
apart from acetic acid, I mean, yeah.
No. There is acetic acid is a major input for this kind of products. Of course, the raw material prices across is going up, as you know. But in these products, acetic acid is the key raw material.
Okay. So this 18% kind of EBITDA margin, should we take it forward for FY22-23 or better than this? Because this year we saw a lot of volatility in price, some benefit of pricing. So in this scenario, your input will be crucial.
As I have mentioned in the earlier question also, that very, very difficult to give any guidance on our margin part because raw material prices are not in our control, market conditions are not in our control. However, we will definitely try to see that our overall performance, as I mentioned, should be better than last year.
Ranveer, I would just want to add, we had said it last time also, in this particular life science chemicals business, it is better to see the absolute amount that we are making. So it's always better to track the absolute amount rather than the percentage margins because here sometimes the value of the sales changes because of the acetic price. So it is better to track the absolute value of the product.
Okay, that fine. And why I was asking about margin front because for 300 or 350 crore kind of capex for FY22, and I believe that 63 crore we have in work in progress. That is it part of that 350 crore or 63 crore in work in progress is related to earlier capex?
It's part of 350 crore.
Okay, so if the margin front, even we see currently what kind of profit we are making every year, and we have a long-term, capex plans also for 900 or 1,000 crore. Every year we are making 300, 350 crore. So any risk margin, any down, contraction in margin would actually will affect our repayment of debt. What currently we are talking about. Debt would be reduced. So, am I taking it in the right way, or you are confident that either volume or margin will improve further, so we'll have enough cash for this program?
Ranveer, if you see, sorry, our net debt as of 31st March is only 431 crore. Our debt is 0.77 times, and our debt equity is about 22. So from the balance sheet side, if you see, we are very, very comfortable. So, and we have in the earlier part of the call also explained that currently the cash generations are very healthy, and we expect to meet the capacities from the internal. So we do not see much of it.
Okay. Thanks a lot and all the best. That's it from my side.
Thank you. The next question is from the line of Ronil Dalal from Ambit Investment Advisors. Please go ahead.
Yeah, hi. Congratulations on a good set of numbers. So my question was actually that compared to your large domestic competitor in textiles, they have been able to perform significantly better on margins. So is there any reason behind that in terms of the more backward integrated the technology, larger scale of operations? Is there any reason for that?
Yeah, all that what you said is one the reason. Our scale, our backward integration, our spread of customers, our spread of geography, and our strength in securing the raw material at right time, at right price, all that cumulative makes the impact.
Right. And in terms of the backward integration, to what level would you be backward integrated in your products, like especially ethanol, acetic acid?
No, so in terms of acetic anhydride, there is not much of backward integration there. So the acetic acid is the key raw material. But yes, the
Right.
scale of operation and the entire utility, which is all in-house, and the effectiveness of utilization of utility, cost optimization, those are the factors. And as I mentioned about our spread of customers and geography to place our products across the world.
Right, right. And so you were mentioning in cost, you were saying that the saving is because of you'll have some in-house source of power or something, or?
No, so our